seasonal pattern. We like to look at this, a lot of
Right.
folks look at seasonality, of course. We like to look at it's kind of a backup signal. You're always looking for supporting evidence to what your analysis is telling you. This chart has averaged over a very long period of time. And what is of note in the month of September, here we are, September 13th. And that's approximately when this chart is suggesting a low.
Jim Curry with the Gold Wave Trader. How's it going, Jim?
Oh, hey, Andy, I'm doing well. Thank you. Thanks for having me, by the way.
You're very welcome. So let's talk gold here, and that's what you do. Just start walking us through what you're seeing in the short term, intermediate term, and longer term here in the gold markets.
Sure. The main thing that we track, Andy, is cycles. That's the basis of my work, and then we use technical information and price to kind of guide us along the way. But we can maybe just go straight into the charts without wasting
Please.
time and get a look at what we're expecting. The first chart.
Yep.
The first chart that I sent you shows a 10-day cycle. We track cycles from 10 days on up to about a 4-year for gold. We found that gold tends to really cycle better than really most markets. I do the stock market as well. But gold seems to cycle better. It breaks out and then it goes for periods of a long range, which is what we like to look at as short-term traders that want to kind of capitalize on the up and down swings. Now, this chart here shows in this 10-day cycle, which is the smallest cycle that we track, and in blue, I have labeled the peaks and the troughs for this wave over the past 4 to 5 months. And we do that by detrending. So it is this detrend indicator on the bottom where it says 10-day detrend. Shows us the approximate locations, but it's not a real-time necessarily indicator. It kind of goes back. You can get the prior highs and lows, but to trade the market currently, you have to use something else. On the right-hand side of this chart, where the 10-day detrend, basically this detrend will project forward what the cycle is expecting, what the next move is, and you can see that this cycle right now is in looking for a low, and then it's looking for a rally. So we think we're near a short-term bottom. We've been looking for that for a few days, but we don't necessarily go in and try to pick a bottom, Andy, because I found that's almost a lethal thing unless you have some strong technical signal to do so, and that we don't have right now. But what we look at are price reversal points. It's an indicator or a concept that I've developed that basically it's when the momentum flips back to the upside. What is the point where price is telling you that the cycle has bottomed? And then what do you expect to follow? Okay, and I will get into that in a second. But anyway, the takeaway from this chart number 1, this 10-day cycle, is it's in bottoming territory. That in itself,
just, excuse me for interrupting, that's just from the price action we see in this chart.
Right. Yeah, the cycle itself, I think, is some 14 or 15 days long. So the average rotation is 10 days. But there's a plus or minus variance, and what we have found is when the cycle starts to extend. In other words, if a 10-day cycle is still making lower lows at 15 or 16 days, it tells you something bigger is in charge. And for that, we can go into chart number 2 because we found that an extended cycle tells you that a bigger cycle is working on a low, the next cycle of a larger degree, and that cycle is a 20-day cycle. So you have a 20-day moving average. And now, why do I have a 20-day moving average on this chart? Simply, what we have found, Andy, is that the cycle has a very strong tendency to revert back to a moving average of the same length. So, sometimes it does it tell you very much information. Right now, we're so close to that 20-day moving average that even if the market could rally, only has to rally 10 points or $10 to get up to the 20-day average. So it's not really telling that much now. But when you start getting away from it, like at some of the tops and the bottoms back, say back in May, when you got really extended above that, then it tells you that you're certainly looking for a correction.
Yep.
If we combine what I mentioned earlier with our 10-day cycle, it's in bottoming territory. We want to say, well, is this 20-day cycle also in bottoming range? And here on the 20-day D trend, you can see that it is. So this cycle is looking for a low. So we have a 10-day cycle. So that is a stronger confluence that says that we're ready to, we should be ready to get a decent little bounce rally here in the next few weeks. But we think it's going to end up as counter trend for reasons I'll go into in just a bit.
Got it.
And I mentioned to you earlier that we like to look at price reversals. So I use what I call reversal points. It's the point at which momentum overtakes the cycle from down to up. And for that level, as we are speaking here in Wednesday's session, gold would need to overcome the 1951 figure for the December 2023 contract. So if we get above that, that tells you that these 10 and 20-day cycles have bottomed, and then we would expect a nice follow through to the upside. And that's where our traders that trade futures would go long at that point. And then expecting, what I would think, we're going to get some retest to that 1980 swing top that we saw, maybe go as high as 2000, but I think the rally is going to falter. In other words, it's not going to go and take out that July peak that we saw. 2020.
Why do you say that? Yeah, why do you say that?
Well, yeah, I'll move into that. Let's see. Maybe we could go on down to chart number 3. So basically what we have here is we have a 10-day cycle and a 20-day looking for a low and a decent short-term rally. The gold seasonal pattern. We like to look at this, a lot of folks look at seasonality, of course. We like to look at it's kind of a backup signal. You're always looking for supporting evidence to what your analysis is telling you. This chart has averaged over a very long period of time. And what is of note in the month of September, here we are, September 13th. And that's approximately when this chart is suggesting a low. Of course, now this chart is suggesting a very strong rally into late September, say early October, and then from there you get it down again until like late October. I don't know that it's going to be as strong as this chart shows, but it certainly favors a rally. There is resistance around the 2000 level, plus or minus 1990, 2000. Thinking we test that level on the next upswing of these smaller degree cycles. And then from there, we come down. And your question that you asked me was, well, why do you think the rally is going to fail? Well, you're always looking to cycles of the next larger degree. So if you got a 10 and 20-day cycle going to ready to rally, you think, well, is this going to be a really big rally, or is it not going, or is it going to kind of fizzle out? Well, for that, we go up to the 72-day cycle, chart number 4.
Got it.
And this cycle, presently, by the action of the D trend, again, is our best estimation of when it's going to bottom. It's projecting a low around mid-October. So that would say if we rally into early October or late September, early October,
then it'll come back down again.
Then you come back down, and then you will maybe take out that 1913 swing bottom that we saw back in August. That would be my preferred path. The market, Andy, I mean, you've probably been at this business long enough to know it doesn't always give you what your expectations say. So, if we were to go out and take 2029 to the upside, that peak that we saw, then obviously this cycle has already bottomed. I mean, there's no way that it could be pointing down if it took out the peak. So, but there's various levels of resistance, again, around 1980 to 2009, centering around 1990, 2000. So if you get that rally until, say, late September, you test that, then as a trader, I would be looking for that rally to fail or look to take the first reversal point to the downside. Again, if you go back and you take out 1913, into this mid-October period. And let me also add this. I should add, because I know you have listeners probably never heard me before. The D trend is always the best current guesstimation of where the cycle is going to bottom. So if, let's say the market gets hammered, it does worse than what I think it's going to into October. Here you are in mid-October. Well, this D trend may project a low for, it may push out that bottom for the latter part of October. And there's always a plus or minus variance when you're dealing with any cycle. So we can't always rely on time, but it gives us maybe a rough window of what to expect. I've always said the market is not perfectly predictable, but it's semi-predictable enough to where we should be able to take advantage of the up and down swings, the movements in between.
Right. Got it. Okay.
Okay.
Then go ahead.
Yeah, go ahead if you have a question.
Well, talk to me about the 300-day, 310-day upper band and lower band cycle.
Sure. Yeah, the chart number 5 shows this 310-day cycle, which is the most dominant, really midterm cycle that we track, and it's been responsible for all the big up and down swings in recent years. Now, if you look at this little blue channel that encompasses price action, you can see the big rally that we got into last year. That you came down into November. You had that big bottom, and then market rallied up, and we said back in April, May of this year that this cycle was topping. And the 310-day moving average, and I've told you that the market will have a strong tendency to come back down to a moving average of the same length. And you can see back in May we were 2150 or whatever was, and then you had this 310-day moving average, was obviously well below that. So we knew that market was going to come back down to that. So that had us bearish in addition to some other things. This cycle, the D trend on this wave is actually projecting a low around November or December of this year. But there's you have a 310-day cycle that could be plus or minus 2 months in either direction. So you have to use something else. But that 72-day wave is due to bottom mid to late October. So that the next downward phase, or the current downward phase, the 72-day cycle may well end up as the low for this 310-day wave, depending on action from technicals. Something that we look at, if we can move to chart number 6.
Yeah.
I have an indicator that I've developed a number of years back. That's a proprietary indicator, and it's done really very well for us in calling tops and bottoms. I don't like to call a top or a low unless I see a divergence in an indicator we call the gold timing index. It's on the bottom of this chart, number 6. And if you look to times the last 310-day cycle bottom, you go back to October, November of last year, the market came down. This indicator started diverging back in late September. The market did make an initial low there. It came back up, gold, and then came down for a marginally lower low into November. And you can see, I didn't mark it out as clearly on this chart, but at that November bottom, there was a sizable divergence in this blue indicator. We said at the time, this is going to be a major low or a key low for gold, because the 310-day wave, the average rallies are 20 to 25% off the bottom. So we got a 20 to 25% rally that's coming. And this indicator said that it's starting, it's a point where you would want to start buying or take the first reversal to the upside. And when it took that number out, it was, that was all she wrote. We got that nice rally, and it didn't stop until January. And in January, we came up, we were kind of above these upper channels on this chart, which in itself is not a major thing. Price can hit a channel or a Bollinger Band or whatever, and then can continue on up. But you get it to a point where this gold timing had formed its first divergence. And that divergence gave way to decent correction into February. Nothing major, but you don't want to set these things out if you don't have to. If you're trading the long side, which I tend to kind of stick with gold, I tend to be more bullish with markets. And as the market was bottoming out in February, there was a divergence in this indicator, and that led to that low that we saw. And then we got the nice rally, and we were expecting that rally to end up as, or that decline, into February to end up as counter trend. Just based upon patterns, the 310-day cycle was pointing upward, so you wouldn't to back to take out that November bottom. So you would have to expect a counter trend decline, which we got, and then the market come back obviously, and then took out the highs into May. And again, we say, well, what is our indicator telling us now? At the time, we had a divergence in our 72-day D trend, which is, again, it's not a major signal, but it's something we look at. It's also a momentum indicator, these D trends. But that gold timing index was forming a divergence. So we said, when we knew at the time the 310-day cycle was topping, so we had a downside risk for a drop back to the 310-day moving average, and which we obviously got. So now, we fast forward to right now. You say, well, what is this indicator telling us? Well, if you look at the August low, it was below the prior bottom in price. The indicator came down and made a complete tested low. It didn't. It took it out, I think, by just a marginal fact, kind of a double bottom. It looked not enough to offer up a ton of information. If we had formed a major divergence there, I would say, okay, that this is it. This is the bottom. It's not going. Our 310-day cycle is going to come early. But that didn't happen. So, our assumption is just looking at the indicator, looking at the 310-day cycle, look at our 72-day cycle, that the low, the ultimate low, the midterm bottom is going to be out there somewhere, probably occurring after mid-October, and it could push out even further depending on the action of this timing index. If it starts diverging on a new low at that time, then I will say, hey, it's time to start looking to buy. You got a 20 to 25% rally with that 310-day. And it's probably going to last into the summer of next year, simply based upon an analysis of time. We like to look at these things and kind of average them out. So that would tell us. So that's what we're looking for. We're just kind of waiting to see how this is going to play out.
Got it. Let me ask you this: do you play just the futures or the options, or do you play the equities or the ETF when you're trading this?
Now myself, Andy, now I trade almost exclusively the ETFs.
So
The
GDX?
futures, now my subscribers, most of them will play off the futures contract. I'm more of a low key guy, more of a conservative person, and I don't like to get in futures. There's too many variables in there, but I have traders that are professionals that do much better. To be honest,
Sure.
they seem to be doing better with it than I am, and they will play off the futures. Mainly, what they do is they trade the reversal points. In other words, I told you if we were to get above 1951, a lot of these guys would go long, and they would anticipate a decent rally, and they would kind of have some kind of a stop in mind. And sometimes they will wait for the reversal to the upside. And they will buy the first little tiny pullback that they can get to lower the risk.
Right.
But now for me, I like to play the ETFs. I usually stick with the GLD on the long side. Sometimes I'll go with the GDX.
Got it. Do you usually see on this I don't know what you see. So do you usually see the stock, the GDX breaking out first, or do they usually break out together?
Well, the GDX can be a leading indicator. It's not always. If you want more bang for the buck, a lot of people will. That's what they play. I've got subscribers that play these the GDX and or the leveraged gold ETFs, and I think even the GDX has a leveraged version, more leveraged than what it is, if I'm not mistaken. And they will play these up and down swings with that. Again, I'm more of a I think it's due to my age and being in the market enough
Yeah.
that you learn over the years that the market will a lot of times will turn you into a conservative
Yeah.
person. So
Yeah.
all
No, I
about
get it. I get it. I get it. Interesting. Also on your charts here, I always used a 200-day moving average, and just out of curiosity, why do you choose these? I mean, why didn't you use a 200-day moving average? Out of curiosity,
well.
is this a historical analysis that you've had, or?
Yeah, what I do is I put on the chart the moving average that equates to the cycle length.
Yeah,
Now, but
right.
if you were looking what market turns forecast, there's a 180-day cycle that's pretty dominant in the stock market.
Right.
I don't put a 180-day moving average on the chart because it's not the key psychological level that the institutions will play off of. So I always put the 200-day moving average. So I do use the 200-day, but I use it mostly with the stock market.
Okay, that makes sense. Yeah, that was just I used to be a commodities trader working for a firm when I was much younger, and we would watch the 200-day moving average very intently, and so that's
Sure.
why
It is a
I
key
asked that.
level. Yes,
Yeah.
a 200-day is a key level.
Okay. Any other indicators that are not in your charts here that you tend to like? Do you look at round numbers? Do you look at different other chart formations for breakouts or anything like of that nature?
I will look at chart formations if I see something that shows up to me. I'm not really a chart pattern trader, but it's hard to miss head and shoulder patterns or
Sure.
flags, or when you see them, and if they line up with my analysis.
Sure.
I like to look at the hedgers, the commercial hedgers on the futures, uh, especially for the stock market. Maybe not quite as much. They're always net short on the gold, but I do look at those. I kind of lean toward, I don't post a lot of different indicators that I look at, simply because it seems like that if I get too much going on in a chart, then it tends to make more questions and make more problems than it is to just kind of stick with the standard stuff. And I have to be honest, I don't even look at a lot of news because I get a better feel for the market if I can just look at what is this chart's telling me. And again, like anything else, nothing is 100%. Nothing is always
Of
right.
course.
We
Yeah.
have our points that we can say what negates our analysis. If we were to get above 2029, like I said earlier, the 72-day cycle is bottomed, and very likely the 310 days, simply because in order to turn that 72-day higher, it has to be a cycle of bigger degree, and the cycle of bigger degrees is 310-day. So that gives you a point where you can kind of use that as a level to watch.
Yeah, no, I really appreciate that, actually, because I found through, and I've been doing this for 25 years, and I don't have all the answers by any means, but what I find is, specifically in technical analysis, is the more complex you get, then you can make a chart say, the indicators say whatever you want it to say.
Anything that you want. You're
Yeah,
correct.
so that gets frustrating. So I do like what I really like and admire about this, and what caught my attention is just the less is more. And you're really going off of seasonality, which is a lot different than, which I do too. I mean, it's a lot different than what you typically see with, again, somebody doing technical analysis, and then you just get in the weeds, I feel. So
Yeah.
yeah, that's excellent. Anything else you'd want to add about this? It looks like we're coming up, we're about, according to the charts, and again, nothing is for certain, but we're 4 to 6 weeks away from, well, maybe not that quite, but yeah, I'd say four plus weeks away from a pretty good seasonal bottom here. Anything else would you like to add about that?
I think the main takeaway from what I said was that, yeah, right. Yeah, I think we're near a short-term low. You get a short-term bounce, maybe of a few weeks, end of September or something like that. Look for indications to maybe get out of. If you have enough stomach to play the short side of the market, by all means do so. If the market is making a lower low into mid to late October, then we will certainly be looking for an indication of a bottom, because you don't want to miss that 20 to 25% rally that follows.
Yeah. And that's when, really, again, going back to the miners, that's when the miners really start to run,
Sure.
during
Yeah.
that big run, when you have a 20% plus run in gold. So
Sure. Right.
excellent. Hey, Jim, if people want to get in touch with you or check out, where they find you to check out your products and to get in touch with you?
Well, you can, for the gold report here, you can just go to the goldwavetrader.com, and then they can find me there. And, we have a subscription based service. I publish my Gold Wave Trader report Sunday evening, Tuesday evening, Thursday evening, 3 times per week, and with an intro update if we need to do it, if something changes. So that's where they can get up with me, and I think that's it.
Okay. I will put all of this in the show notes, for both Apple, Spotify, as well as on YouTube. So all the listeners and viewers can just click on the link to find you. So
Yes.
thank you so much, Jim. I do appreciate your time.
Yeah. Thank you, Andy. I appreciate it.